AI stocks will crash. In this video, I'm going to explain exactly what is going to crash, what that's going to mean for the prices of stocks, and we'll specifically touch on Nvidia, supermicrocomputer, and then we'll apply this to the broader industry of where opportunities could be. I want to be very clear up front, I am invested in chips and chip-making technologies, both personally and through an actively managed ETF that I run. Now, in this video, I'm going to make some very clear concerns known to the world. The last time I discussed Nvidia on its own video, I predicted that the stock would go to the $600 to $700 range. I predicted that would happen in 2 years. This makes this a $600 stock by 2026 with this sort of growth rate. And if we include the other aspects of the business, you're actually at close to an $840 stock. You're looking at potentially an 80% return over the next 3 years to potentially a double, even at today's levels at $375. Unfortunately, it happened within 9 months, or I guess fortunately, depending on how invested you were. It happened way quicker than expected, so my timing on that was wrong. But now, given that we're sitting right up against the next Fibonacci retracement level, which is serving as a resistance for Nvidia, it's about 731, we have to ask ourselves, are we ready to move to 969, or are we going right back to where we were at 493, where we topped out? In this video, we're going to work to address this. We're also going to consider Supermicrocomputer, who has maybe an 8% net profit margin selling you server racks to basically put your AI chips on, but currently has a relative strength index of 90, down from the 95 that it had this morning. So in other words, something's either gotta relax here or the growth probably has to stop at some point in the stock valuation because it's done a pretty dang number already. And from a technical basis, it is ready to either pause or come right back down. So in this video, we're going to present the potential for the AI crash. Now, what we have to understand is that AI will crash. But first, we have to realize how it will crash. So let's come up with an example to make this relatable and simple. Let's say you do not have a cell phone. You have no phone at all. So, in order for you to check your email, you have to go to a computer, you have to go to a landline to make phone calls, and maybe you're faxing things that need to show up quickly. I don't know, whatever, right? You don't have a phone. We all know, we all have a phone. Everybody's like, come on, man, how is this relatable? Well, because I want you to think about for a moment not having a phone, and then I want you to think about having a phone. What you've done is you've thought about going from zero productivity in your pants, in your pockets, to a lot of productivity. Okay, now I want you to sincerely tell me, how much does your productivity go up when you go from that iPhone 14 to that iPhone 15? Not much more. You're probably about the same level of productive. Maybe you're 1 or 2% more productive, but you're infinitely more productive than before you had the phone. And of course we could argue about that. We could be, well, you get distracted in the bathroom on TikTok or whatever. This is really a topic for a different video. But the point is, you went from zero to a massive level of productivity having a phone. Having the next generation phone, your productivity probably didn't move that much. That is the difference between an infinite growth curve and a marginal growth curve. And what is that going to look like for AI and the AI moment? Well, in my opinion, and this is inspired by a course member lecture that we did this morning, this. AI had a massive growth impetus. Companies went from we have AI, we have no AI, to now we need AI servers. Okay, so we need AI servers. So what are we gonna do? Well, we're gonna call up Supermicrocomputer. We call up we need 1,000 server racks as soon as possible. Hey, AMD, we need 1,000 CPUs. Nvidia, we need 8,000 H100s. Everybody's going from zero to a lot. And that's how, when you go to a company like Nvidia or Supermicrocomputer, you look at their growth year over year in like Q1, Q2 of this year, you're double. Right? These companies' revenues doubled. And it happened to Nvidia, it happened to Supermicrocomputer, you've seen it at companies like AMD. I mean, look at Nvidia, for example. You went from $7 billion of revenue ending April 30th, 2023, to double that, 13.5. Well, so roughly double that, right? That's pretty incredible. That's actually really, really good. That's great because the quarter before that, they didn't grow much at all. In fact, they shrunk. So what's remarkable is you had a PC hole where now Nvidia is trying to get you to install LLMs on RTX PCs to motivate you to buy more PCs so you could download your own RTX chatbot now and install it. It's like a 35 gigabyte file. It's a big deal. A lot of people are talking about it. I actually have it right here. I just haven't finished installing the darn thing. But anyway, what's remarkable is you went from a company that was really focused on gaming computers and yes, to some extent helping in automotive and servers, to having a product that was perfect for this moment, this spark, the AI, the moment of companies going from, we have cloud compute, we have cloud storage, but crap, we have no inference, we have no AI. Okay, so what do? Well, we create the AI servers. Now we have AI servers. Do we need to replace all of our H100s that we just overpaid for? You know, $35,000 for something with an MSRP of $8,000? Do we really need to go replace all of those to get the H200, which is all the rage right now? Why? Because, well, Nvidia tells you it's all the rage. It's so much better. Why would you buy the H100 or the cheaper A100 when you could have the H200? And soon we'll be on the B100. Keep in mind that like these charts are designed to sell you the product. The reality is all of these chips are incredibly powerful. And if you actually showed the whole bar chart, you're probably only looking at like nominal differences that they've zoomed in on. But that's okay. That's how product refresh cycles work. Notify me when the product becomes available for the H200 Tensor Core GPU. Point is that the next model of the GPU, just like the iPhone 3G or the 3GS thereafter, is not the big deal. The big deal is the moment you go from iPhone or from no iPhone to iPhone or no phone to phone, right? For you Android folks. I have an Android too, okay? It's actually pretty good. I just hate that I can't easily get files. It's like, FaceTime somebody? Oh, here's your Google link. What? What's that? Oh, I shouldn't go down this. Shouldn't go down that path. I do have it. It takes great photos. I will tell you that. The Pixel's pretty good. But this is going to happen. Not only is it going to happen, this crash is already occurring. This is not necessarily a crash in the stock price. However, a crash in stock prices can happen. We're going to talk about that in a moment. This is a crash in growth. So when I say AI is going to crash, that is not speculation. AI is going to crash. It will crash. These AI companies' growth levels will crash. There is zero question about that, because we already know it's happening. Go into Nvidia's earnings. Sorry, I've got a bunch of notes written on here from what we do in our course member live streams. But look, we've gone from doubling revenue quarter over quarter to growing revenue, say 60% quarter over quarter, to growing revenue, 34%. Now that was a beat. That 13.5 billion was a great beat. It's 13,500 millions is the way this is written. So therefore 13.5 billion. That was a beat. But we went from doubling our growth to growing 34% over each quarter. And that's still phenomenal growth. But wait a minute. Now they're only projecting 10.3% growth. It's slowing quarter over quarter. Of course it is. Because now everybody who needs an iPhone has the iPhone, just to stay with the scenario, right? Okay, so now Nvidia does have a tendency of beating. Right now they're forecasting $20 billion in Q4. Their earnings are, next week on the 21st of February. They'll probably beat again. They usually beat by a factor of 1.8 to 1.48 post AI. Don't worry about how I came up with that. The point is they'll probably end up showing somewhere between 15 to 19% growth in Q4, their fiscal Q4 2024. In other words, the next time they have earnings, okay? So they'll probably show some good growth, but it's not a double anymore. It's not even a third growth anymore. So the point is, the crash of growth is happening. So then we have to evaluate, okay, when we conduct a fundamental analysis on a stock, we generally look at earnings. Okay, so what are earnings going to provide us? How much cash flow am I going to get? Now, in the case of Nvidia, the cash flow generation is phenomenal, but that's for the company's cash flow. Your cash flow is earnings per share. You get earnings per share growth, then the stock either goes up or they pay it out in dividends. So earnings per share growth is one way that it's just one of many ways we can conduct a fundamental analysis on a company. And so what we want to see are earnings growing. Earnings can grow in a number of ways. They can grow through more revenue, adding a new vertical like the AI inflection point. That drives the top line way up and of course the bottom line way up. Or you can become more efficient by potentially laying people off or spending less money on research because maybe you don't need to as much anymore, or whatever, right? Those are all ways you can grow earnings. When it comes to the artificial intelligence revolution that we've hit, once companies have their artificial intelligence, the question becomes, how much is earnings per share going to grow at AI-related and AI-adjacent companies like Supermicrocomputer after we're done with the AI craze? Well, part of this has to do with a very special word, margin. If you were previously, which is a pure definition of absolute pricing power as a result of supply chain shortages, if you were pricing H100 chips at $35,000 and your MSRP is $8,000 and your cost to build the chips is $4,000, so that's cost, that's manufactured suggested retail price, and you're able to sell them, your actual sell price is $35,000. Well, the reason there's a wedge here is because there's a supply shortage. So you raise the price. It's kind of price gouging. Really rich companies is what it is. And that's okay. Like whoever is willing to pay the most should get the product. That's how capitalism works. It's like an auction effect when there's a shortage. Okay, fantastic. So what happens when that shortage goes away because that boom, the adoption of AI, is gone? Well, when the boom goes away, then what also goes away? Well, it's obvious. Your ability to charge $35,000 for a chip goes away. Now, don't get me wrong, it's still fantastic that you could sell these chips that you're not even making Nvidia, you're just designing them. That's not to like insult you, it's just like, it's really impressive, right? The point is, you're going to see margin compression from AI because we are at insanely inflated levels of margin today. So there will be margin compression as supply equalizes and of course competition increases. I mean, don't count out AMD here or some of the other competitors trying to get into AI. There will be competition. And eventually, just like there's the Android and the iPhone choice or whatever, there will be many equally capable, some slightly better than the other chips. Sitting here and like comparing specs of different chips doesn't matter because what really matters is going from no AI to AI. Okay, but that's happened. So the price levels to some extent are justified because we do now have a new revenue vertical. And we do have more earnings per share, which is likely to be durable. That earnings per share will likely stay for a while. So, I mean, Nvidia is now pumping out nearly $5 in earnings per share. The question is, when does that $5 per share change? Well, it could change very slowly unless there's another AI impetus. Consider that by the end of 2025, we'll be at $6 to $6.50 current forecast. So, and before that, just to go back another year, we were sitting at like 60 cents of earnings per share. So draw this for a moment. Right here, you're at 60 cents of EPS. Then you get to $5 of EPS per quarter. And then you're at $6 of EPS per quarter. Of course, the growth rate is insane over here. And then, of course, you're going to get articles like you get from Barron's. They're being some knuckleheads right now. Barron's put together an article and they're like, oh, Nvidia's really, really cheap. Look at this. If you take the growth between 2023 and 2025, Nvidia's PEG ratio is just 0.3. Whoa, wait a minute. You can't take last year's growth levels and average it with the forward growth levels because we just went through a massive adoption phase. I mean, it's the same thing as having like a giant one-time expense, okay? Let's say on your house, you spend $30,000 a year to live in your house. That's your payment and maintenance, okay? The furnace goes out, whatever. $30,000 a year is what you spend. But 1 year, you spend $60,000 because you install a solar system. Oh my gosh, your costs of living in your home just doubled. Well, yeah, but it was a one-time adjustment. Then we're back at 30, right? So now we're back at normal level. So we have to adjust for those things. It's the same thing for revenue. Okay, if we go from 0 to say 60, and then we go to 66, we went through infinite growth to 10% growth. So the growth is still going to be there. It's just going to be more incremental as you go through product refresh cycles, just like you do with the iPhone. Okay, fantastic. So what does that mean for valuations, and how do you actually run a valuation on a company like this? Okay, so this is what I like to do personally. Okay, so this, just put it all out there. I'm gonna make this very simple, and we'll run through a few of these together. So I like to discount for this AI segment future growth rates. And what I'm going to do is I'm going to run PEG ratios based on what I think is personally reasonable. So this is, not a guarantee, but we look at a company like Nvidia. Nvidia's growth that is projected over the next, and it's so hard to look out, right? But the next 4 years of growth for Nvidia are currently projected to be 70.5% EPS growth, 16.5, 17.2, 17.7. That's 121%, but we divide that by 4, we have an average growth rate of about 30. So 30.5% EPS projected growth. I personally think Wall Street analysts are probably being too bullish on this number. Why? Because product refresh does not mean the growth goes on forever, A, and B, margin compression. Literally, Barron's is screwing this up, trying to tell you that Nvidia has a 0.23 PEG using last year's momentous growth. You can't do that. It's stupid. It's a great way to delude yourself. So what would I rather like to do? Well, I would rather like to go in here and we're going to go slash that because I am worried. I'm substantially worried about margin compression. Okay. I'm going to say if we could just keep the earnings and grow it a little bit, we're doing good. So let's say we grow at 10%. Nominal product refresh cycle growth. Let's just say. This could be way too bearish for the company, okay? But I'm going to go with it anyway. I'm going to go with 10%. The current price of Nvidia is sitting at about resistance, so 730 divided by earnings per share for this year, which is the earnings cycle that is being announced next week. We're going to divide that by 1236, which is the expectation, puts us at 59 times. So now I'm going to divide that by 10. My PEG ratio for Nvidia is actually 5.9. That's pretty high with 10% growth. So if I think that the PEG ratio should be 3% because sentiment is strong and people want to allocate to AI, be part of the future, whatever, it's a stretchy PEG ratio, but let's go with 3%, then the stock is probably worth half of what it's trading for right now at 10% growth. That might be too aggressive. And I realize that. I don't think 375 is the right number. So what happens, just so you can see how quickly this could change, what happens if we assume Nvidia has 15% growth and we're okay with a 3 PEG? Okay, simple. So we can back this in. $750 divided by the 1236. 1236, that gets us to that number, about the 58-ish, right? And in this case, sparing you the math, a reasonable price range for Nvidia, in my opinion, is probably 550 to 600. That's probably where we ought to be. And if growth ends up going lower than this, then I think the stock will get substantially squeezed down, possibly back to that 495 region. It all's going to come down to growth projections. If Wall Street's right and we end up getting this 30.5 EPS growth, well, by all means then, that's fantastic. Now we're at a 1 PEG. So that's great. And if it's supposed to be trading, if we're going to have 30.5% growth going forward, and this stock is going to trade at a 3 PEG, then a fair valuation based on what Wall Street is saying is actually 1,130. So where growth ends up, the longer term 4-year growth trajectory, where it ends up is what is going to decide the value of these companies. So now, as an investor, we look at, let's go optimistic and say Wall Street is right, we're going to go 30%. Okay, what's the potential growth we have for the stock? Well, 1130 divided by today's price, 730, still 50% growth in it, in that optimistic scenario. It's also possible Wall Street's too pessimistic, that AI is going to grow even more than anybody ever thought possible. In that event, well, the stock could be worth a lot more. What if growth's 40%? Run that, for example, 40%, take to 1236, we'll take a 3 peg. That's going to bring us to $1,500 a share. So everything's going to come down to what that terminal rate of growth is for these companies on an annual basis. And that's why I'm saying the crash will come in growth. And I'm concerned because we've gone through this momentous shift that analysts are being too optimistic on these companies for growing. So that's my take on Nvidia. Now, how does this apply to companies that are AI adjacent? So what about like a Supermicro computer? Well, I would actually be even more concerned for a company like Supermicro because I think once the servers are installed, you're not refreshing the server racks. You're refreshing, maybe you're going from the H100 to the B100, right? You do every 2-year cycle refresh. Unless you're expanding more servers, you're not necessarily buying more racks. And so I'd be more concerned for a company like Supermicro Computer, and I'd be more skeptical of their EPS growth going forward than I would be for Nvidia. Like I would have less concerns about Nvidia than I do for Supermicro Computer. But then again, their stock does look really beautiful for now. So what about a company like Intel? Well, Intel really hasn't even had an opportunity to participate here yet. Intel's really just operating, in my opinion. I don't underwrite Intel as a company that's really a chip designer. I underwrite them as a chip maker, a manufacturing company, a plant that's being subsidized by the US government via massive chip supporting stimulus checks. That game is still has room to play out. I think this is a $64, $65 stock. I think it's a diversifier. It's a it could be a value trap, but I see it as an opportunity to diversify with. So then you have to ask yourself, after growth crashes for the AI companies, are people going to say, all right, I guess I have to go find another growth stock, and then sentiment shifts? Probably. Sentiment will shift. Sentiment is very bubbly right now. It's very FOMO, hugely momentum driven on these stocks. That's why the RSIs are as high as they are. That almost rhymes. But anyway, sentiment will shift at some point. And that sentiment does not necessarily mean the stock will crash. Look, Nvidia's RSI went over here to 49 to 50 when the stock was flat. The stock just has to stop skyrocketing and the RSI can come down. You don't necessarily have to have these stocks crash in stock value. So for me, it's very difficult to short these companies, certainly with like short-term options. I mean, you could go into earnings, obviously, and try to play a short here. The volatility is a little high on Nvidia right now, so you'd probably be better off selling options. What I would personally like to do is make sure that I'm diversified as well as possible into where's the next wave. I don't know that we're ready or primed for like the next big AI breakout, like that next inflection point. I don't think it's here. So then the question is, okay, well, what other stocks would people go into once they start selling the AI sector or we stop having as many inflows? Probably at this point, that becomes a better investment than chasing AI after what it's already done, knowing that the growth will and is already crashing. Everything next week is going to depend on Nvidia's guidance. If Nvidia tells us, oh my gosh, growth is accelerating way faster than we thought, all of our estimates are wrong, all the orders that came in January, oh my gosh, there are even more than we even thought possible. We thought last year we had shortages, now it's even worse. The stock will double. It's just not ending. If, they beat slightly and then they give their forecast and they're like, okay, so we grew 18% this quarter, next quarter we'll probably be at the same level, and they go flat growth quarter over quarter, whew, try to do a PEG ratio on a company with no growth. It don't look very good. You don't use PEG ratios for companies with no growth. It's not possible. But the point is, you can't divide by zero. But the point is, at some point, and we don't know when that is, growth will flatten, margins will compress, and there is substantial risk that EPS projections are way too optimistic. There is also the potential that you could end up with negative EPS on what I call tough comps. That's really bad because now you have negative growth. You want to know what company had negative growth? Well, there are two I could think of. One is called Enphase, and it did that. Another is called Tesla. Investors hate negative or shrinking earnings per share. But when you have companies, and this is really important to remember too, when you have companies with really, really bad numbers for a year, what you've done is you've set up an easy beat. Next year, people are like, oh, the numbers have stopped going negative. Oh, wow, look, y'all are growing like crazy. Duh, because you're comparing to a low number. And then the question is, can you sustain that growth? How long can you sustain that growth, right? But now it's the opposite at Nvidia or a lot of these AI companies. It's like, oh, the growth is so high. Oh, why is it going down? It's all going to come down to growth. I think we had our AI wave. I don't know we're going to have the next part of this massive wave for another 5 to 10 years. So I'm becoming a little...
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.